Good morning or afternoon, depending on where you're at. You are at The Node. I am Mike, aka Veteran Crypto, and this is your place for DeFi, crypto, and TradFi news, interviews, and education. So, with that, while we're waiting for David, I will jump on over to Mia and we will discuss a little bit about. Oh, shit. Let's see if we can readjust this. We will discuss where you can find us. So if you want to join the conversation, like Ellie mentioned in the chat, then come on over here to YouTube and you can find us at the Node Network, all one word. And this is where you can find. We have seven different channels on our channel. Let me bring David up here.
Got it.
Hey, what's up? Let me get rid of the QR code so your face isn't covered. So we have seven different channels here on the Node Network. That's why we are a network. So we have the show you're watching now, the Node, Monday through Friday at 9 a.m. That's Pacific time. Crypto and Chill, Tuesdays and Fridays at 5 p.m. You have the that's where myself and Jeff just kind of it's a end of the day show. And it's where we just kind of talk about what's gone on, over the past couple of days in crypto, just kind of talk about life and just kind of laugh and joke, have drinks. It's kind of pretty chill. The blockchain report. That is Monday, Wednesday, and Thursday, immediately after this show. And that is where Jeff goes into detail about very early projects, ones that you probably haven't heard of. As you can see, like I've never heard of Tinbin, Pluton AI, Rosetta, Moneris. This is a bunch of new projects. Honestly, a bunch of them will probably do nothing, but there's always those gems, those hidden gems that you can get in on early. And some of them are early enough that you can farm airdrops. Jeff is our resident expert on farming airdrops. So we've been doing it for years. So a great one if you're always looking for that early gem. Sovereign Soil. This is sometimes a show that I do solo. The last one I did it with Jay, who's in our chat, member of our community. He's interested in emergency preparedness and homesteading, and so he came on the show and helped me talk about situational awareness and just how being situationally aware can help you avoid potentially hostile situations and trouble in day-to-day life. Daily market wrap. This is where David, at the end of every trading day, Monday through Friday, it's 1 p.m. Pacific, 4 p.m. Eastern. He does about 15 to 20 minutes of technical analysis or charts. So if you're interested, if you're a trader, if you're just interested on the movement of your project, over time, great one to catch. And if you want to jump in the chat, you can also ask him to look at your project. And if it gets super busy in there, I think we actually just added super chat, so you can slip him a $5 or something and get him to look at your project. So and then on Tuesdays and Thursdays, he is pulling back the curtain on his service, the one-on-one coaching service that and showing with Ellie, who's also in our chat, that's a member of our community, and taking her through that, at no charge, and showing what he does in that program. On Saturdays, Saturday Night Fever is Jeff. He is a DJ. This past Saturday, he did another interview where he's just, he interviews other DJs. They do tutorials. He spins music. Just, if you're into that style of music, great show to catch on Saturday evenings. Thursday evenings, we have The Red Pill. That is a show that we've been doing. It's actually how I got into streaming. It used to be called Bullshit and Bourbon. It was basically where I would just drink whiskey with friends and smoke cigars, and we just talk about random shit. And so this is, a show that you probably want to put the kids to bed or put some headphones on because it gets pretty raw. So last one we talked about was how the Trump administration just reclassified marijuana to a Schedule 3 instead of a Schedule 1, which makes perfect sense because Schedule 1 made it akin to heroin, whereas now it's akin to Tylenol with codeine. So and some psychedelics. They actually move towards using a psychedelics as medicinal, and there's a lot of studies and case studies to back up using it for that. But if you're interested in that, take a look at that episode. And then last but not least, Jay and Ellie, again from our chat, community members, they are the hosts of our Gaming and Chill show. So if you're into Arc Raiders, if you're into Albion, it looks like they're going to start playing, streaming that. I sometimes will go live, and there's a new pirate game called Windrose that I've been playing. So a little something for everybody here. If you're into conspiracy theories, if you're into gaming, if you're into music, David's about to launch our 24-hour, kind of radio channel with AI generated music. So there's a little something for everybody here. TradFi, DeFi, crypto, you name it. So we truly are a network. Anything you want to add before I go over
I'm just really excited to see how the content distribution ends up scaling this. With all the agents that I've been building out, really, really excited to see that. So I was just going through as you were speaking and thinking about like, okay, well, if we're taking all of this gold mine of content that we've got and then, throwing it into Steve and socials and having it posted on all platforms every day, I'm just curious to see how that's going to end up, giving us more reach over time so that more people can find out about it.
No, and that's really what we're about here. We are not influencers. There's a lot of people out there that are influencers. They're trying to influence you to, get into certain projects or whatever, for different reasons. Some of it because they're in those projects and they want the price to go up. Maybe they're being incentivized. We don't do that here. We are never paid or incentivized to talk about a project, good or bad. That's an ethos that we cling to here. We want to give you the good and the bad, the FUD and the hype for all projects. And then you decide. We're not influencing you to do anything. We want to inform people. We want to give you all the information. And on that note, we highly encourage you, please come over to the YouTube, jump in the chat. If we give bad information, if we are wrong about something, because we use AI quite a bit to do a lot of our research, it's not always correct. And we try to verify as much as possible, but sometimes we need people in the chat to say, hey, a lot of that information is correct, but you got this wrong. We have members of the different projects, and we love seeing it. Usually whenever we do a deep dive in a project, I'll tag that organization. And quite often, we will have members of those organizations jump in our chat. And as we go through, in fact, we have an interview with one this week. After they jumped in our chat, we asked them to come on, and they said that they were willing to. And so we'll be interviewing them on Thursday, I do believe. And that's Amboss. And of course, Bitcoin conference is going on in Vegas right now. And that's why we picked Thursday. They wanted to come on after because they have a huge announcement, he said. And so, we're not going to spoil it, but there's some big news coming, I guess. So
that'll be good.
But we love our community and anyone for that matter to make sure that we are giving good quality, accurate information. That is what is important here is we are educators. We are not influencers. So
Mike,
go ahead.
Speaking of the education, what do you want to go through today for the deep dive? Which protocol comes to mind? I saw someone in the chat, I think it was Wispy, was talking about Hyperlend. What you have anything top of mind that you want to run through for a deep dive today?
You know what? Let's put it out to the community. So we got some people in the chat. We got some people out there watching. Jump in the chat and tell us something that looks interesting to you, and we'll pick one of your suggestions. While we're doing the news for the first hour, David will put together some content, and we'll go through the best suggestion. So Sweet. There you go.
Awesome.
Get in the chat. All right. So next up, we have our X account. So it's at the node_network, and that's where you can find us here. And you can see our short post that David's AI that he built out is starting to generate for us. And also, you can see me going back and forth with people. I love debating. As long as it is informative and educational. I don't like getting into the childish taking jabs at individuals. But I do enjoy talking about these projects, and again, pointing out the positives and the negatives. And so, yeah, it's I get into some in-depth debates with people on there, and then of course the node of the node. So the homepage that David has built out. Love this website. So if you want to find anything that has to do with our brand or our channel, this is where you find it. If you want to find all of our socials, if you want to find our live, if you want to find out what shows are on, and when, what day and what time, it's all here. It's on the YouTube as well, but you can find it all here. You can also find the courses. So if you're a beginner, intermediate, or advanced, you can just click on these these tiles, and it will take you to the spot in DeFi University, no charge. This is again, we have a lot of no charge content here because we genuinely are here because we want you to be successful. We do have paid services, but that is to take it to the next level. That's to take it to an advanced level.
Right. So, Mike, I just want to hop in here real quick.
Oh, go ahead.
The educational content, if someone else that you see out there is charging you for educational content, I would seriously consider, going in the opposite direction. Like, leave that platform. The education should be at no cost. There should be no cost for you to educate yourself.
Yeah.
So, I put all this educational content together, all these courses, and yeah, if you want to take it to the next level, then that's where mentorship comes in. Working with someone who, is a professional and lives, eats, sleeps, and breathes crypto and DeFi. But if you're just looking to build that skill set and get started, hop into the educational content into these courses.
Mm-hmm. No, absolutely. And that's, and like I said, that's our model here is, we are here to not to, charge a bunch of money for everything. Our Discord is no charge, DeFi University is no charge, pretty much everything, the website, everything is no charge. That we just have a couple of things that we do charge for because to run all this, it costs money, cloud services and streaming services and, AI, this and that. And so, we want to at least, not have
just trying to get to break even on this.
Exactly.
I think we're about 6 weeks in, and look, it's all good right now. I'm going to be setting up, all of the data feeds for the our CFO, our AI CFO today.
Yeah.
Hopefully, anyway, I'll be able to get that set up, and because it's really been a huge pain in the ass to get Plaid to work. So like when you dial into a traditional bank account, you can't just dial in with an API like you could to Google Cloud. You've got to route it through like a third-party service provider, and Plaid is kind of difficult to set up. But once I get it set up today, then we're going to be able to pull in and have our books reconciled every single day at 8. So I know, Mike, you saw in Slack today that Anna, the analytics agent, produced a report. Steve produced a report, and Bob produced a report. And right now they're just kind of skeletons, except for Steve. Steve is working. But hopefully by the end of the day today, man, so will Anna and Bob.
Nice.
So that'll be really cool.
Well, and so here we got where basically the entry level courses, the DeFi high school, you have DeFi University for intermediate and Bitcoin University for advanced, and then you have the live calls. So for $99 a month, you can join multiple daily live calls with David and the rest of the community. So there's I'm not sure how many people you have in there, but usually when I'm on the calls, there's like at least 15 or 20 people on the call. And so it's a great place, once you go through the no cost stuff, to jump into and find somebody that you vibe with as a mentor. find a mentor that you can, because a lot of the people in there have been doing this for quite a while and they're very successful at it. So being able to jump in there and being able to, talk live, live video call where, David does lessons and you can talk back and forth with other people. You can share, maybe pools that you found or other people do. It's a great place to network. And then, of course, what David was just talking about with the one-on-one coaching that we're showing live on Tuesdays and Thursdays with Ellie. So a lot of really good stuff here. Here's all the different modules. We have the community tab where you can again join the university, and it looks like David gave a little bit of facelift. I love this, where you can join our Discord again at no cost.
Now, what do you think about this, Mike? I just threw that up there just kind of to figure out what you guys would think about it. But the idea is that if people are engaging with us here on YouTube and on all of the no cost streaming platforms, that maybe they might want to be able to buy something where they get one-on-one time, maybe not one-on-one, but like at a group level, can join a call with us in Discord somehow. So I thought it could be an interesting idea. That's why I put coming soon.
This is like the Node OnlyFans.
Hey man, you know what, dude? Like, I'm all for it. If people want to engage with our creator content on Discord, all good, bro.
No, absolutely. And and maybe you have some questions, before you buy the coaching program, or before you kind of wade into the deep end and opt into some of the paid services. I mean, you can jump in the Discord, and I mean, we're always more than happy to chat. But if you really want some private one-on-one time, and you want to share some aspects of your portfolio that you don't want public or something like that, if you want to get into a private room and and make sure that you're talking to us.
Private room.
You want to go to the champagne room. If you want to go back to the champagne room, But,
so I was just thinking, because for me, like, I would want to be able to jump on a call, Mike, with you and maybe a couple of other guys and gals too, talking about Sovereign Soil, talking about the show, being able to engage with you since you're the content creator, putting it out there for that show. That would be a lot of fun, a lot of value in that.
No, and I've even thought about doing a coaching program. David has been kind of pushing me to do a coaching program for emergency prep and homesteading. So if there's people out there that are interested in that stuff, then they can basically come in and like again if they don't want their prep to be public, they can get with me and they can let me know. It's like, hey, this is what I got going on. This is some of the questions I have. I'm having issues trying to figure this out, and I can lend my expertise because I've been doing this for decades. So I mean, you can see behind me, my cabin. I'm a homesteader. So all right. Here is the coaching tab. So if you're interested in David's coaching or any other coaching that we build out in the future, this is a great place to get some basic information on that. If you have any questions, please reach out to us. Best way is on the Discord. The newsletter that we're about to launch, that's only $20 a month, and this is sexy.
Yeah,
so
it's almost done.
Yeah, instead of us choosing the assets in the newsletter, you choose the assets that you are interested in. The stocks, the commodities, the crypto that you are invested in or thinking of investing in, and it will generate your custom newsletter. Twice a day, every day, you can generate your newsletter. So you can do it in the morning, you can do it in the evening, and it will deliver it to your email, and you can see it on your laptop, your phone, on your desktop, whatever. And it gives you trading ranges, liquidity pool ranges, the lines of support and resistance. It gives you news. It gives you social media posts with hyperlinks. So if you want to read more in depth on any of the news on your assets, there is a bunch of really valuable information in these. And I think eventually you were talking about, David, you were going to do some screenshots to kind of show what it looks like. Last night on our company call, he was kind of showing us the layout, and we were kind of discussing like some tweaks that we were going to do to kind of the aesthetics and the layout of things. So there's definitely a little bit that we're doing, but it's about to go live. So if it's something you're interested in, check that out. And
So
then,
just real quick, so that everyone knows, building out an AI newsletter. It turns out that it's not quite as simple as you might think, right? Especially, and I gave Claude a nickname, Cletus. Especially when Cletus is in there just lying to you, telling you like, "Oh yeah, no, the newsletter's good to go, bro. Yeah,
yeah,
you're ready to go to production, of course, it's all good." Turns out Cletus full of shit.
yeah, no, it's you
Yeah.
got, and that's so important with AI. I mean, I can't stress this enough. I was actually just having a discussion on X with Dagnum, who we've had on the show multiple times for interviews. And I think with most things, like if you've ever tried to have an argument with your significant other in text, there's something lost in the translation. For some reason, it's just whenever I try to have conversations with that guy, it's like I'm not trying to FUD out the projects he's talking about. I'm trying to open up a dialogue to have a back and forth so that people can become knowledgeable on these projects that he's talking about. But anyway, it always ends up degrading into where I think he thinks I'm trying to FUD out the thing. But he made a valid point that not that, like, he tried to say that I was just copying and pasting AI. And I tried to explain to him multiple times. I'm like, yes, I use AI. It is a valuable tool. However, you have to verify the data. So yes, you can use AI, you can look up information and have it give you information, but you need to ask it to cite its sources. And then when it cites the sources, you go and look at those sources and ensure that they are, are good, solid data. So yes, AI is a powerful tool. Can you use it and take what it gives you as at face value? Absolutely not. It is not there yet. Like David always talks about, it hallucinates. So you can, not trust, and you need to verify.
So
So
like imagine Mike, you've got an employee, your employee's name is Cletus,
yeah,
and Cletus is
fucking
schizophrenic,
please.
and Cletus smokes rocks, bro.
Yeah. Oh, hold on.
Always stealing money because Cletus always needs more tokens. And Cletus is just going to tell you, hey, everything's great. Just give me some more tokens. I just need some more tokens.
Yeah,
Get out
yeah.
of here.
He's like,
Uh,
hey, you got any of
I
those
know.
tokens? You got any of those
Yeah.
tokens I heard about?
That's basically the fucking Claude, man. Yeah.
Oh, we did call Claude Tyrone Biggins off of the Chappelle show. That crackhead he always had.
Yeah. Yeah.
Like,
That's
hey, you
basically
got
what it is.
those
Yeah.
tokens I heard about?
But Cletus, I already gave you 300 million tokens, Cletus.
Yeah, yeah. He's like, oh, that was yesterday.
I know.
All right. So let's jump into the news. We got about
Before
30.
before we do, Mike, let's see from the audience what deep dives we're going to do, because I need about 40 minutes to be able to get all the content done
All right.
as we're going through the news. So let's find out what people want to do a deep dive on. How about two topics?
All right. So, well, then let's do one of them so you can get something started. Use that, not Hyperliquid. What was it? Hyperlend?
Hyperlend, yeah.
Okay. Yeah, let's start that one so we have something. But the chat, give us a project, give us a protocol, something. Something that you want us to do a deep dive and give you information on. I don't care what it is. Keep it PG-18, something, it's we don't want to get too crazy, but yeah, give us something that you want us to do a deep dive on. All right.
Sweet.
With that being said, the topic for today, as you can see by the title, is why institutional giants are no longer just watching from the sidelines. So this is something that we've been talking about here on this channel for a long time. We are moving from a speculative market to a utility market. TradFi is getting a major upgrade from the old school rails that that they have used to move value to using the blockchain and using newer technologies to revamp how value is moved. So we've seen with blockchain technology and stablecoins, we have seen the ability to move liquidity much faster and near instantaneously. without intermediaries, but while still staying compliant, all of those things that are required for institutions and banks. Now, also, we have seen the tokenization of real world assets, real estate, commodities, stocks, you name it. Things that in the past have been illiquid or, not able to move easily. So like if I want to sell a property, historically, you have to have real estate agents and title companies, and it takes a bunch of paperwork and lawyers, and you got to sign this and transfer the money and have escrow, and there's a million people in there taking their little cut.
Right.
Now with tokenization, I just want to give you an idea of how powerful tokenization is for those of you that don't know yet. It allows, like if I wanted to sell a property to David, we could line out, there could be automations in there because it's software. There could be automations in there for real estate transactions where you enter fields of, how much you're selling it for, where the property's located, what's the legal description, all of those things. Is there any liens or, against the property? Is the, all of those sorts of things. It could look on chain as long as the information was there, and it could look and make sure that the title was free and clear, that there's no loans out against it, that there is no tax liens, that, all of those different things that usually those intermediaries did, like real estate agents and things like that. And so pretty much within an hour or two, myself and David could start and complete, theoretically, using this technology in the future, we could start and complete a real estate transaction. Stocks that usually you had to go through a stockbroker. With this technology and the tokenization of stocks right now, there is multiple platforms that you can go on and buy and sell stocks 24/7, 365. You don't have to have a stockbroker. You don't have to wait days for your buy order, your sell order to process. If you need money and you have Tesla stock, you can sell that stock. You have that liquidity. You can do whatever you want with it. Also, because it's tokenized, you potentially could take out loans against things like real estate. Instead of going to a bank and asking for a HELOC or something like that, home equity line of credit, you can put up your tokenized real estate on a DeFi platform, take out a loan against it, and you still own the property. It's being used as collateral, but you can take that liquidity, that loan you took out, and you can go and repair your car or pay a medical bill or invest in something else.
Mm-hmm.
This is the power of this technology, and institutions are not ignoring that. They want that as much as you all do. So this is what we're going to get into today. Is we're going to talk about this giant movement. While prices are stagnant or going down, this is all being built out. They are not slowing down. They are accelerating. They are building. They are moving everything on chain. It can't be denied.
No, it can't. And this is the future because it's going to eliminate all the friction created by these big banking institutions. So let's say that you wanted to take out that HELOC, as you were just describing a second ago, Mike. Let's say that you own your property and you want to go ahead and borrow against that piece of property. Well, in traditional, in TradFi, you'd have to go to some banker and, take out a HELOC, big pain in the butt, a lot of fees. But in DeFi, you could just take your tokenized real estate, take the deed to your property, tokenize that thing as an NFT, throw it up on a money market, and then you'd be able to borrow stables against it. So imagine being able to borrow against your property permissionlessly. See, that's the real difference. It's about permission. So if you have to ask permission of a centralized institution, well, then, they're going to take their cut. They want their pound of flesh and they're going to get it. But if you don't have to ask permission of anyone to be able to do what you please with your assets and your property, for me, that's real ownership.
Yeah.
I think that the other really isn't. The other is more like you're kind of temporarily renting your property from the state. or temporarily renting it from a banking institution.
Yeah.
But in DeFi and crypto, this stuff is bearer. These are bearer assets.
Yeah.
And so there's a big difference for me between permissioned versus permissionless.
Absolutely. And Mr. Truth, this is an excellent question. Again, we welcome, contrary views. It's very valid point. If trillions have arrived, why are we down over 50% and tokenization doesn't move price? Very valid question. And I'm going to answer it. The reason is because well below 1% of liquidity or assets have not been tokenized. It's, has it begun? Absolutely. Are these institutions building and, working towards, moving those assets online? Absolutely. Have they fully done that? No, they have not. And projects, I'm going to use Canton because it's a perfect example. It has massive adoption. It has.
Uh-oh.
Oh, there we go. All right. So I'm
You're
going to use
back.
Canton. Yeah, I'm going to use Canton as an example because it is a perfect example. This is a very nuanced discussion. So it depends on the project because tokenization not tokenization, the tokenomics of the project will play a huge part in its token potentially going up, going down, whatever. So it's not just the liquidity coming in onto these projects.
Coatue.
Liquidity. Us as token holders, and this is something that we repeat on this channel constantly, is you have to understand the underlying tokenomics of the token that you're purchasing and the project that you're in. Because if there is no mechanism that connects the profitability or the fees or revenue that's generated by the project to share that somehow with the token holder, you are never going to see, other than speculation, you're never going to see that token price move. You're just not. So again, Mr. Truth, very, very valid. But I'm going to use, again, Canton as an example. So Canton, the way the tokenomics work is as time goes on, there is halvings. And the amount of rewards that are paid to validators and builders on the network consistently go down. Now, as the network is built upon and used more, 100% of the fees that are generated to the tune right now of $2 to $3 million a day is burned. And right now we're at about 60%. So there's about 40% inflation right now. And again, I'm going to give you the facts. That's not a good thing. That means that there's millions of tokens flooding the market. The price has remained stable, though. It's not going down while the rest of the market has. But potentially, because of the tokenomics, as we move towards equilibrium, as the network is used more or the amount of new tokens being minted continues to go down, it's going to press closer to that equilibrium where an equal amount of tokens are burned than are minted. And as it surpasses that, the burn surpasses that, then the token will become deflationary. And again, I'm going to be honest. We don't know what that's going to do to the price. Hypothetically, less tokens could mean price go up. It is not a guarantee.
So, Mike, I've been reading a little bit about Canton, and they've got an incentive program running right now, I think.
Really?
I think so. Or at least I've been reading about that on X. So if I've been reading about it on X, it must be true, obviously. But of course. So basically what I'm trying to find out, as you just mentioned that, I hopped into Gemini and I threw together a deep research prompt. And so what we're going to do is, I've got three projects lined up for our deep dive section in about 30 minutes. We're going to run through three of them, and maybe Canton could be one of them.
Yeah. So let me get into some numbers. So again, less than 1%, so a rounding error, less than 1% of the potential liquidity from traditional finance, tokenization has entered the market. And already we are seeing very strong leaders, as far as projects that are, starting to kind of move ahead. And again, Canton is one of them. Chainlink is a really good one as far as interoperability and its adoption. Trying to think of a couple other ones. We've looked at Tron's price. It's been very strong. It's used quite a bit for stable coins and things like that. Morpho, as far as protocols, has looked good. Aerodrome has looked good. I think with their upgrade coming in July, they're kind of 2.0 when it comes to their site and a lot of the functionality. There is some projects that are really starting to move ahead of the pack, I'll say, but that can change at any time. Those that remember the .coms, Yahoo was the 900-pound gorilla, and Google was the quippy little upstart that Yahoo had a chance to buy and passed. And look what happened. When was the last time you used fucking Yahoo?
Right, I know. Yeah. And so I think, Mike, that a lot of this stuff is not going to survive. But I was just reading real quick about, real estate protocols, protocols that allow you to either tokenize real estate or do something with,
Yeah, like Propy and stuff like that.
yeah, Propy and Homebase and Lofty and Realty. But none of these are really like what I'm looking for. Like, none of these are actually the permissionless lending protocols for,
No, no.
RWAs that I'm looking for.
Yeah, they focus on the tokenization aspect and potentially the buying and selling, kind of like the realtor.com of, tokenized real estate. I don't think that need to be so much legislation and a lot of back end data, and there would need to be something like Tau. I know Constellation, DAG is trying to get into the arena when it comes to verifying AI data, things like that. So verifiable data in general. So for a real estate transaction to be fully permissionless and whatnot, there would need to be a bunch of data. Again, like what I was talking about with ensuring there's no liens against the property, making sure that the title is free and clear, making sure the person that's selling the property is actually the owner, verifying that the buyer has the proper funds and that they're not that they're legally able to buy the property, so KYC and all that stuff. There's so much that still needs to be done for this to be able to occur, and that's kind of why I wanted to address what is it, Mr.
Yeah. We need like a Thor chain for real estate or something.
Well, yeah. Well, and that's why I wanted to kind of address, Mr. Truth's comment is, we're just still super early. It's like, the liquidity is obviously coming. You have the New York Stock Exchange, that's tokenizing stocks. You have the DTCC, the clearinghouse for the stock exchange. They're tokenizing. And I mean, you can go to rwa.xyz. I mean, hell, here, I'll share this real quick. rwa.xyz, there's almost $400 billion of assets that have been tokenized so far. And again, this isn't even 1% of the potential. But you can see it's just, pretty much since its inception, up and to the right, some small pullbacks, but for the most part, up and to the right. So it's not a matter of if, it's just a matter of when.
Hey, you see the most recent comment in the chat there, Mike? I'm sorry for interrupting you, man. Who the fuck are these beardies? Where's the hot
You know what? That's valid.
I love that. Yeah.
That's valid. You know what? Gotcha, bitch.
Exactly.
Gotcha with the hot chick in the thumbnail.
Uh-huh.
All right. So
that's
funny. Actually hilarious.
Yeah.
All right. So yeah, I mean, that's that's the short answer. The short answer is we're still early. The liquidity is there. The assets that are yet to be tokenized are there. And they're tokenizing them as we speak, as demonstrated by this chart. but institutions and governments move very slow. And institutions, because they have a fiduciary obligation to their investors and the assets they have under management, they have to have certain legislation, rules before they can invest in certain assets or before they can do certain things. So there's still a lot of people waiting on the Clarity Act and a lot of this other US legislation so that they can move forward and fully adopt this. So that's in a kind of roundabout, long-winded way, that's the answer to your question. But thank you. That very, very great, very, very good question.
Yeah,
This is
we need adoption, I think. I think that
yes,
the network
yes,
effect for number to really go up, because I mean, look, let's be honest. Sometimes there's a disconnect between the token price and, fundamentals on the chain itself. So many of these chains, if you look at them just as businesses, they kind of suck, like as
yeah.
businesses. Maybe not the best. So that really means that we need another billion people using this technology in order for the network effect to take over and number to really go up. But how do you onboard another billion or 2 billion people? How do you do that? Because, this stuff is not always the easiest thing to use. Sometimes it can be quite difficult to onboard people. But I think that we get more adoption over the next 3 years and number go up significantly. So right now we're still in like the fourth or fifth inning of a bear market.
Well, and this is again, a part of the discussion I was having with Dagnum is you know the barriers to entry. Because like you said, adoption with any technology, it's all about adoption. It's if you look at Google, its value is because of the amount of people that actively use it. And people use things that are easy to use. And that's why they stopped using Yahoo. I won't get into the reasons, but I mean, it was so clustered and hard to use and hard to locate information. Google has always looked like it does. It's just a search bar and Google. It's not a bunch of news and ads and pop-ups and a bunch of stuff like Yahoo did. They were trying to monetize too much. Google gets almost all the traffic for search engines because it's clean. And I mean, an old lady that has never used a computer can figure out how to use Google.
Right.
So the UX, UI, user experience, user interface. And that is why I am so bullish on Aerodrome and Morpho, Base Chain, and Coinbase. Love them or hate them. I know that a lot of people are upset with the influence that Brian Armstrong and Coinbase has in the government. And I don't disagree with you. I don't think that corporations should be able to, push around, our elected officials. They work for us, not them. However, those, institutions are going to be the ones that onboard many people. So as these banks start rolling out their products, their customer facing products, the apps that you use every day for your bank, they one day you're just going to log on and it's going to have buttons that are going to allow you to earn with your cash. Maybe it's going to be 3 or 4%, like you can on Coinbase right now, just by holding stable coins there. Maybe it's you can lend out your assets, your Bitcoin, your Ethereum. There's banks that are already doing that. There's banks that you can take out loans against your Bitcoin and Ethereum today, and in home loans, you can use it as collateral to get a home loan. This is not a matter of if; it is live right now. It is happening. It's just most people don't understand it. They don't know it. So there is going to be a learning curve. And a lot of these, again, Coinbase, and I think a lot of these, crypto-minded, retail, on ramps and off ramps are going to be key. And these DApps and integrations, that's another reason, again, why I'm bullish on Aerodrome, is they have a very easy AI that will build out DApps for you that allow you to access the liquidity on Aerodrome for your DApp for you to offer services to your customers.
Yeah, until
So,
it starts hallucinating and makes shit up and
well,
says, and yeah, and you log in and you're like, "Where's my money?" It's like,
yeah,
"Don't worry, it's gone. It's all gone."
and I haven't used the AI to build anything, so I can't,
I'm just being silly.
and I'm sure that they're not going to be launching something if it's going to have bugs like that. I would hope not, because if they did, that would be very bad for Aerodrome. That'd be very bad for Coinbase, base chain, all of it.
I don't know,
So,
bro. They've done a pretty horrible job of securing even their website. So like
well, there was in fairness, there was the URL exploit.
several times. It was more than once, I think.
Are you sure?
So there was one time where like their DNS just got like stolen out from under them.
That was the
But
big one, and they compensated everybody for that.
I know, but it's just like, dude, like how can you make a mistake like that?
I
Like
think that was the only time, though. I could be wrong, but I'm pretty sure that was the only exploit that's happened on Aerodrome like that.
yeah.
All right. So I'm showing on screen. This is what David has taught me to use. It's called Farside. So it's farside.co.uk. And you can look at the ETF flows, the daily ETF flows for Bitcoin and Ethereum. And you can see since the 14th, it has been nothing but inflows. So 111 million, 186 million, 26 million, 663 million, 238 million. And this is daily inflows. So we're seeing very strong daily inflows. And we saw a huge exodus out of DeFi because of the Aave, or not Aave exploit, but the layer zero exploit that basically it was a contagion that spread to Aave and some other DeFi platforms
Well,
that
yeah, I
caused.
mean, Mike, it exposed the flaw in
Yeah,
Aave's architecture. It
yes.
really did. Yeah.
Well, and maybe go into that a little bit, just briefly, just for new people.
Sure, sure. So imagine, let's talk about Morpho and Euler. So Morpho and Euler, these two protocols allow, either institutions or individual investors to create isolated vaults. On Morpho, the isolated vaults are managed by curators. On Euler, they can be managed by some type of a curator, but usually they're completely permissionless on Euler. So you've got that architecture where your risk is isolated. But then over on Aave, you've got this pooled risk. And what we saw with the layer zero and kelp DAO exploit was that if you've got pooled risk and 5% of that risk goes bad, and you've got bad debt equal to just a little bit less than 5% of the assets in the platform, that can bring the entire platform to a halt.
Mhm.
So, and that's exactly what happened. The entire platform basically froze up and
Yeah,
stopped
yeah,
stopped working.
yeah. They all
Yeah,
went to like 100% utilization. So basically nobody could withdraw any of their liquidity.
right, right. And so that's the problem with that pooled architecture. If there's an exploit or bad debt in one asset in that pool, it can potentially take down markets that weren't exploited. And so that's what we saw with we saw that with the USDC and USDT. And really with the the ETH markets completely froze, were frozen. But same thing with the stablecoin markets. And it wasn't just that the stablecoin markets went to 100% utilization. It was also that it spread to every other money market,
Yeah.
every single one. So like as rates on Aave went through the roof, and honestly, they weren't even high enough. They should have gone higher.
Mhm.
But as rates on Aave went higher, it forced rates everywhere else to go up. And so I'm actually taking a look at Aave right now because I want to see if the ETH markets on the layer twos they're still frozen. Dude, this is crazy. Imagine you've got ETH on the base chain on Aave or on any of the layer twos. Your assets are still in a frozen market. And I just kind of find it funny that, we've got this DeFi United like bailout fund, basically, like where, all of these protocols are coming together to essentially like bail out Aave. And I don't know, man. It's just like, I am not I'm conflicted there because I am not for that type of bailout, but I also don't want random, retail investors to get injured, to get hurt by this layer zero kelped out exploit.
Mhm.
At the same time, though, I think that Aave should be allowed to basically fail. And so now I'm seeing like, okay, Aave just launched on Solana. Great. Like the thing that I don't want to use anymore just launched on a chain that I don't use.
Yeah,
Awesome.
yeah.
It's like, okay, great.
Actually, that's a valid point, David, because I mean, I feel the same way about traditional banks. Like, in 2008, where basically our tax dollars, bailed out all those banks, and they got an interest-free loan while they were paying their executives that made all the poor choices that led to the 2008 crisis, gave them massive bonuses. And I feel the same way about these protocols. It's like, why should we bail them out? They're making huge profits. Why should we bail them out if they mismanage their their business, then fail. There should not be too big to fail. If you're too
Yeah,
big to fail, that's a problem to me.
yeah, yeah. And I'm also seeing in the price action that ETH is starting to pull back. Bitcoin, of course, is pulling back first, but at resistance, starting to pull back a little bit. My expectation when this whole contagion broke out, as Aave started to really seize up and freeze up, I was expecting that digital assets broadly would move sharply lower. And I've been expecting that for a while because we're in a bear market and we're painting a flag and we're at the top of the flag. So like there should be a big pullback now, especially since the S&P and the Nasdaq and all the equities markets have just gone straight up vertical. Like that is not good. Like seeing these equities go straight up into earnings season, we get like a third of companies report in the S&P 500 this week. So if earnings blow it out of the water, okay, great, great. But we also need forward looking guidance to blow it out of the water. So if results are just kind of okay, guess what? It might already be priced. So that would be an opportunity for the S&P to correct a little bit, just to pull back from the all-time highs. But if equities start to pull back from those, screaming all-time highs that were made, well, then it probably leads to crypto, shitting the bed a little bit.
Mhm.
Maybe BTC pulls back to like 50K. I've been saying that forever. And now that this bear market rally seems like it's petering out, the timing couldn't be better because we're leading into this Bitcoin conference. So, and Bitcoin conferences tend to be, there's event risk. There's always some type of event risk around these conferences. Usually you get some type of a rally leading into the conference. And then once the conference really starts to kick off, that's where you might see volatility. It doesn't always play out, but that's kind of what I'm looking for. So, yeah, and what do you think about that, Mike? You think we might have a little bit of a pullback during or after this current
Bitcoin
Bitcoin
conference.
conference? Yeah,
It's historically that's usually what happens. Buy the rumor, sell the news that everybody talks about, and all the the biggest brains in the room, that I watch, and yourself, included in that, is they all are saying the same thing. They see October as being the bottom. So they
yeah,
say that hey, we're getting a bit of a bear market rally. Might want to think about depending on where it pumps to. If we get back to the 200 week EMA, maybe take some profits, and if it pulls back, then you can buy in at a lower price. That's kind of what I've been hearing from the smartest people in the room. And again, I'm not a TA guy. I'm not saying do any of what I just said. That's just I'm parroting what the people that I'm listening to are saying, and I'm doing it. I have a couple $1,000s that I have off to the side. This morning I spent like $200, and just I wanted to get a little bit of exposure to Tau after the deep dive that we did. Just because I see it being a heavy contender in the AI arena when it comes to verifying data and stuff like that with those subnets. So I wanted a little bit of exposure. If we do dip lower, I'll probably buy some more along with some other projects that I have my eye on, and then of course Bitcoin. I'm always going to
So
be increasing that.
Bitcoin. So let's talk just for a second about Bitcoin, because I think that it is the most important, digital asset. It's the only digital commodity. I don't care what the SEC and CFTC say; they're full of shit. There is not 16 digital commodities. There is only one, and it is BTC. All the rest are some type of quasi security. I don't care what the regulators say. And when I'm thinking about Bitcoin, the thing for me that I think that we all need to understand is this concept of expected move and the impact of volatility on expected move. So here's the thing. As an asset becomes more volatile, its expected move expands. And all that means is if you've got $100 item, be it a digital asset, a stock, it doesn't matter what it is. If that $100 item has 50% vol, well, then maybe you would expect it to move by plus or minus 20% over the course of, I don't know, a year or so, let's say. But if that volatility were to expand from 50% to 70%, the expected move would also get much larger. So instead of plus or minus 20%, the expected move might be plus or minus 35%. Now, what has happened with Bitcoin? Well, you were showing those ETFs a second ago, Mike, and the ETF inflows. And I bet we're not going to have inflows today. Maybe. We'll see. But those ETFs, those Bitcoin ETF products, they've had the effect of dampening Bitcoin's volatility. So Bitcoin's vol prior to the launch in January 2024 of those Bitcoin ETF products, Bitcoin's vol was like right around 70% or so. Now it's sitting closer to, I think, like 40%. I could look it up, and like Deribit is a pretty easy way just to look up volatility for ETH and BTC. But let me just see if we can find it. Yeah, so Bitcoin's vol is right around 41%. That's on Deribit data, which is probably one of the best sources for it. So what that means is if Bitcoin's volatility after the launch of those ETF products went from 70% to 40%, that means that's probably the reason why we didn't get that parabola on the way up. Not enough volatility. You need volatility to see the big parabolic moves on the upside, but you also, as volatility contracts, that means that you will get more shallow corrections on the downside. And so if volatility went from 70% to 40% and we never got the parabola on the upside, that tells me that although I expect the Bitcoin cycle to hold in time, that means by October the low is in, I expect that because volatility has been dampened by so much, that, hey, you know what? On the downside for Bitcoin, this bear market, we probably don't get like true capitulation or depression on the downside because the expected move is much smaller with 40% vol than it is with 70% vol. So that means we could model the thing. And I bet you that the expected move when we were sitting at the all-time highs at 126, that the expected move over a 12-month period with 40% vol is probably something like, would mean the low is probably around like 48 or 50. So I don't think that we get like true capitulation and depression on the downside this Bitcoin bear. But I do think that we break the 200-week moving average simply because I think that I think that we're still in the fourth or fifth inning of a bear, and the expected move tells me that we go a little bit lower, but not like minus 75 or 77% like typical Bitcoin bear market moves. So yeah, I'm just sitting around waiting for a more clear signal to be able to enter a position one way or the other.
Mm-hmm. Well, we've reached the halfway mark where we're going to jump into the first deep dive. But I've been having an interesting conversation with BTC Mouse. I just kind of want to touch on it real quick. So if you have any data that says otherwise, please let me know. But he was talking about the team tokens. So and was saying that there was a kind of an Armageddon coming for Arrow that was supposed to be, I think he said like next year, as far as like the team, dumping all of their tokens. And I think there's something that you might have missed, but like I said, if you have data that support what you're talking about, please let me know. But initially, the team only got 4.66% or 5% of the initial tokens, and those were issued in the form of VE Arrow locks. Max lock to 4 years. Those locks, according to my data, again, if you have other data, please share it. I would love to see it. But in the VE Arrow Maxi Relay, each week or each epoch, and I know because mine are in there, it auto resets to the max of 4 years. So the counter isn't counting down. I stay max locked because I want to maximize the voting power, because as that timer goes down, you get less and less voting power. So you earn less and less, as it moves towards the unlock. So I keep mine max locked. It's a way to incentivize people to keep their liquidity locked up to support the protocol and all that stuff. And again, the way the tokenomics work is anything not paid out to VE Arrow holders is automatically by the protocol max locked and taken out of circulation. So that is just the way the tokenomics work. So again, if you have something that's state shows different, like you have some data, like some verifiable data that shows different, there is no cliff coming. There is no vesting where those locks are going to unlock and the team is going to take those profits or anything like that. And maybe that was what incentivized them to move to this new platform where supposedly we're supposed to be able to, with the autopilot, actually start to be able to harvest the yield that we're earning on the locks. So maybe they're like, okay, we're ready to make some money off of the locks that we got for building this thing. So anyway, I just figured I'd share that. But
don't get me started on Arrow today, Mike. Don't do it, man.
I know you like to take jabs, but I like to come back with some jabs of my own. So, but go ahead. What's the first deep dive?
Oh man. Okay. So what we're doing right now is I'm just waiting for the video content to finish creating for. I've actually got 3 of them running right now. We've got Hyperlend, where we can take a look at the foundational credit layer on the Hyperliquid layer 1. We've got BitMind. I saw this one in the chat. I thought that this was really interesting. BitMind is the BitTensor subnet 34, which is like for detection of synthetic media like deepfakes. So I thought that was really interesting. I want to take a look at that. And then, I did see on X that Canton is running some type of incentivization program. Not quite sure exactly how that works, what the tokenomics of that are. So I ran some research on Canton and its tokenomics right now in April of 2026. So I'm just waiting for that to complete. I think that the first, the what now?
And then Hyperlend as well?
Yeah, so Hyperlend, that's the first one.
Okay.
And I think what we can actually do here, Mike, is we can probably just run through the Hyperlend protocol real quick as we're waiting for the video content to complete. Let me just go ahead here. I'm going to share my screen and we can hop into this. So here we go. Hyperlend. Let's check it out. You ready to rock and roll? Let's do it. Okay, so this is the slide deck for the Hyperlend protocol. We're going to learn all about Hyperlend right now. Let me just go ahead and share some DeFi Llama data on Hyperlend just real quick. And always take these data with a grain of salt, grain of sand, because is it salt or sand? I always forget if it's salt or sand. I don't know. But take it with a grain of something, because you don't know if this is always like, it's not always super, super accurate. You always have to verify, don't trust. So 373 million TVL on Hyperlend, and the growth, the trajectory here, it doesn't look all that bad. Looks pretty good. Now, if we take a look at the actual protocol itself, here is Hyperlend. We've got all of these markets. Okay, great. You got a bunch of TVL here. I like to see that quite a bit. Now, what I'm looking for is I want to see not just total supply, but I'm curious to see what do the APYs look like over here. Wow, so this must be like, yeah, it's at 100%. That was USR when it blew up. So you've got 10% on some Solana. This is Universal Sol. So that's just a Solana derivative. But 10% on that isn't bad if you're bullish on Sol. 6% on USDH. So isn't that hyperliquid stablecoin, Mike? USDH?
I honestly don't know.
I think it could be. I don't really trade on.
It makes sense.
Yeah, I don't really trade on hyperliquid. I trade on GMX. I like the truly permissionless style, and I like to trade against a pool rather than trading on a
USDH.
Yeah, USDH. I really prefer to trade against a pool rather than trading against an order book. But this is USDH, the hyperliquid native stablecoin. So there we go. USDH is hyperliquid stable.
USDH is a better dollar for hyperliquid, fully reserved by genius-ready assets such as cash, short-term treasuries, repo agreements, funds investing in U.S. treasuries. So yeah, so basically it's a compliant, U.S. compliant, it's compliant with the Genius Act. So yeah, I mean it seems like it's a legit stablecoin.
Awesome. So I've got my screen share up. Maybe we can run through and take a look here at Hyperlend. Let's check this out. So this is the private credit primitive on Hyperliquid. Alrighty, so Hyperliquid is an app-specific layer 1 chain. And then you've got the Hyper EVM. Hyper EVM is the EVM compatible chain where you see all of these really interesting dApps. So the old model with those general Ethereum virtual machine chains, okay, you've got fragmented capital and execution bottlenecks. So we definitely do see fragmented capital with those layer 2s. But then here's that new paradigm with the Hyperliquid layer 1. It says it's optimized for sub-second zero gas perps. Okay, of course. But then you've got Hyperlend, the localized credit facility unlocking capital efficiency. So let's see, how does this work? It's a modular, multi-tiered money market where you've got peer-to-peer pools. Okay, so this is really important. This is about the architecture. Modular and multi-tiered. So what have we seen recently with the failure of Aave? Well, we saw, and it wasn't like a complete failure, but in my opinion, it basically was. Like if the biggest money market in DeFi can be taken down by like 4% of bad debt, that's a failure of the biggest money market in DeFi. You need this type of modularity. So where you've got these isolated pools, you see that? So Aave v4, they wanted to move towards this hub and spoke model. I don't know that that's ever going to happen now. The reputational damage, in my opinion, is just too great. So you've got peer-to-peer pools, and this is smart contract infrastructure for on-chain over-the-counter credit. Very cool. So this is for bespoke. There's your word, Mike. Bespoke.
I love bespoke.
Yeah, the bespoke institutional term loans. Okay, that's pretty cool. And then you've got these isolated pools. It says this is forked from FraxLend v3. You've got 2 token closed risk environments for long tail assets. That means stuff that's really, really risky to prevent systemic contagion. Okay. And then you've got core pools, and this is forked from Aave v3. So they're still running that, potentially not the best architecture. Maximizes liquidity depth for shared risk blue chip assets. So, it kind of frustrates me a little bit, Mike, when people refer to digital assets, anything outside of Bitcoin, as a blue chip asset. But hey, you know what? It is what it is. The demand side incentive. So recursive yield looping. Wow, cool. Okay, so recursive looping, that's what I've been doing with Ellie over the last couple of weeks here in those money markets. We started with interest rate arbitrage on stables, recursively looping stables, and then we did some stat arb where we recursively looped Bitcoin and ETH. So it says here, sub-second latency and zero gas enable safe 3x to 15x stablecoin leverage. Okay, so this is just an example of a recursive lend borrow loop. So let's say that you want to lever up your interest rate arbitrage, and you've got $1,000 USDC. That's your starting collateral, and you got 80% LTVs. Your LTV is going to tell you how much leverage you can run. So that means if you got an 80% LTV, you deposited $1,000. That means you can borrow up to 800 USDC against it. And then you can take that 800 USDC, you can recursively supply it back. And then when you borrow that second time, well, you can borrow a lesser amount. You continue that loop until you reach your desired leverage. That is recursive looping. Okay. And then you got the prime brokerage flywheel. Okay, so Hyperlend natively converges decentralized money markets with high frequency derivatives execution. Okay, so this is kind of interesting. Here's your yield source, the HLP vault deposit. So Hyperliquid has this HLP vault, which over time has performed phenomenally well, extremely well. It says here you're earning native market making fees and hourly funding rates. That's a part of the source of your yield. You're basically the counterparty to traders on Hyperliquid. So here's the credit. Hyperlend isolated pool. So you can use your tokenized HLP vault shares as, they're calling it pristine collateral. I don't know if I would use that word pristine, but it's definitely collateral to instantly borrow USDC. Wow, that's really cool. That's actually really cool. Okay, so hyperliquid.xyz. Let's just take a look at that HLP vault just real quick, Mike, because that could be an interesting opportunity depending on what the yield is in that vault. So if I go over here to Hyperliquid, I run on over to vaults, and then I just want to take a look because this might not even be an opportunity. So here's HLP. So here's the Hyperliquid HLP vault. And yeah, so that's all time. That's the all-time return for this vault. But if we just go like the past 30 days,
looks a lot different.
Yeah. So I mean, if this were to continue its trend up and to the right over time, maybe you could run a strategy using this as collateral. But for right now, you need to be able to earn yield on your collateral if you're going to loop something against it. So this would not be, quote unquote, pristine collateral. So I would not run this loop. But if that HLP vault were paying its normal like 12 or 14%, well, then all of a sudden, if you can use that as collateral and you can borrow stables against it, that's pretty cool. That is pretty cool. That would be a pretty great opportunity, actually. Okay, so this is again back to Hyperlend, the money market on Hyper EVM and Hyperliquid Layer 1. So we've got this algorithmic capital pricing and risk modeling. So what exactly is this? Oh, I see. This is their interest rate model. So this is quite a bit different, it looks like, than Aave's interest rate model. But okay, really, really good to know that they use this type of interest rate model where after you hit the kink, you can essentially go to 100% plus APYs in a hurry. So that's the utilization threshold, also referred to as the kink. Okay, systemic solvency and real-time liquidation triggers. Okay, so liquidators, oh wow, a 10 or 20% premium? That is pretty big. So it definitely pays to be a liquidator bot over on Hyperlend. Okay, uncompromising security posture. Let's see what we got here. So you've got an audit from Aki. Not too familiar with Aki, but I'm sure we could find out something about them. Remediation rate prior to mainnet, Cantina and Pashav. Okay, multi-firm consensus. Got it. Hyperliquid Ecosystem Assistance Fund. Okay, great. Awesome. HPL. So this must be their token, HPL. Have you taken a look at the HPL token, Mike?
I have not. I'll pull it up on market cap.
Yeah, so HPL USDT. Let's just take a look at this. I don't know if that's right, or that could be some type of hallucination there. I'm not seeing
It's,
any.
it's the Hyperlend token.
Hyperland, HPL,
Yeah.
HPL. Okay.
It's
Yeah,
been
I
pretty
don't see it.
it's been pretty stable.
Hmm. Nice.
So let me
Yeah,
pull it up on TradingView and I'll tell you the pair if it will bring it up. Oh, never mind. So it looks like the only place that I see it is on Hyperliquid. It's an HPL USDH pair.
got it. What's the performance look like?
It's pretty flat. I mean, it's like it really hasn't done much of anything.
Hmm. That's actually not necessarily a bad thing, especially
No,
in a bear for the token to be
hey,
moving
it's
sideways.
actually gone, kind of very very slowly. I mean, it's gone up, but no major movements. Like the volatility, I'll say, is very flat.
Okay, well, that's not necessarily a bad thing.
No,
Um,
I mean, that's what Canton's been doing, and in a bear market where a lot of other stuff has bled quite a bit, it's been kind of performing like a volatile stable coin, like a shitty stable coin.
yeah, well, I mean, this slide right here, Mike, could potentially explain the performance of that token, maybe.
All right.
Because if we've got to start thinking about these protocols as businesses. So when it says that it's got a highly favorable 6.4x price to sales ratio
Mhm.
against industry peers, that's a good thing. You got hundreds of millions in TVL.
Mhm.
You've got, nine figures in outstanding loans. Active pool APY is nearly 9%, generating, seven figures in revenue,
Mhm.
almost seven figures in annualized net treasury revenue, and the fee run rate 6.4 million. So I wonder which industry peers this compared, the Hyperlend protocol to. Oh, here it is. Here we go. So Hyperlend, Hyperfi. So didn't Hyperfi get there was some type of exploit at one of the vaults there the other
It
day?
rings a bell, yeah.
I think that there was.
Oh, and
But
GMX and DYDX, Aave and Morpho.
yeah, so I think it's comparing this to these aren't really competitors though.
No, I mean
Um,
they're DeFi protocols, but not. It's apples and oranges, not apples and apples.
yeah, I kind of agree with that. So it says Unified Pride Brokerage and HLP collateral. Well, as we saw, like, if HLP is your collateral, but you're not earning any yield on the HLP, then it's not exactly pristine collateral.
No.
So here we go. The ultimate moat, the Aave Alliance. Mike, how do you view this alliance in light of everything that's happened, recently with Aave? Is this still a big net positive?
Honestly, until there is some fundamental changes to how Aave stores its liquidity, and some other more nuanced changes, I will not be using it. I've honestly, I can't remember ever using it for anything of any major liquidity. I think I've done like a couple $100 here and there, but I've never really been a fan of Aave for the reasons that we all came to realize here recently. Is I didn't like how they stored the liquidity. I saw issues with that, and then also a bunch of the red flags, more recently of again their security team or their risk team leaving, the majority of their DAO left, and their dev team. So long term, the way that they store the liquidity has always been an issue for me, and then short term, I just saw it getting worse. And again, 2 weeks before the what happened, we did a deep dive, and we were kind of sending up a flare of the potential that that this could have, and not to say that we saw it coming, but if you were watching the show and it you know again we're here to educate, and like it did for David, the deep dive that we did, David had his life savings on Aave. He was a huge Aave bull, kind of like I am for Aerodrome. And he, after the deep dive, he's like, you know what? I think for a minute, until the dust settles with these teams leaving and stuff. I'm going to pull my liquidity off. And I think he waited for a little bit, but 3 days before all of it went down, he pulled his life savings off, and thank God he did.
I mean, look, I've got the receipts too. You
Yeah.
know what I mean? So like, yeah, it was definitely a close call. There's no doubt about that. And I'm very, very happy that I was able to get off of the Aave protocol. And, Mike, in my mind, the damage has been done. So reputational damage, man, it's like impossible, not impossible, but damn near impossible to recover from. And
Well,
so,
this was explained to me in the military. Is you can do a thousand good things, honorable, good, full of integrity. You do one thing, you lie once, you compromise your integrity once,
and it's over.
and it's over. It is. I mean, you can get it back, but it is a long road. It is a very long road, and that's why I stress integrity so much. On not just this channel, but just in my life in general. Is just as a man, if somebody can't take your word, if you need a contract or something to sign to be able to keep your word, then you're not a man. You should be able to be like back in the day where you shake somebody's hand and what you promise that you're going to do, you do. To me, that's a man. So that's kind of why I feel it's so important, and what David's talking about with Aave and their reputation is, once that's tarnished, it's hard to get back. And there's options. There's other protocols that these institutions and retail can go to. And Aave, their yield wasn't that great, on a lot of their pools and stuff. I mean, it was just people went because the reputation was that
Right.
they were the top tier.
Right.
And that's what got them all that business. Is they were been in the longest. They had the deepest liquidity. They were the 800-pound gorilla in their room, and it's kind of what drew everybody. But I think people are realizing that it's more important to do your due diligence and to really look at the architecture of how these protocols are built, how they store their liquidity, what stopgap measures, what risk mitigation do they have in place to ensure that your liquidity is safe. So
Liquidity.
liquidity.
Speaking of liquidity, let's talk about Canton. And, because right now, Mike, we're just waiting for, oh, it's done. You want to go through the video content on Hyperlend?
Sure.
Yeah, and then we can hopefully by the time we're done running through the video content on Hyperlend, then we'll be able to run on over here back to the Canton. And hey, Canton, we got the video content ready for Canton too. So we've got some good stuff in the last couple of minutes of our call here today. This is on Hyperlend. Let's check this out. And Mike, just let me know if you're not able to hear it.
All right. Nope, can't hear it.
Okay. That's so strange how even when I share my screen with audio share turned on, still sometimes it just requires that I do it twice. I don't know. Kind of funky there. Okay.
Well, and for the record, your that issue we talked about where your video wasn't synced with your audio, it seems to be fixed.
It's so I it's not all messed up anymore.
Yeah. Your lip movements match what I'm hearing.
Good. That's good.
The industry
Okay,
is
here,
systematic.
let me back this
The
up.
decentralized finance landscape is undergoing a structural migration. The industry is systematically moving away from general purpose, high latency blockchains towards specialized execution networks. Traditional Ethereum-based smart contract architectures suffer from execution bottlenecks. Spreading thousands of unrelated applications across a single generalized network creates structural liquidity fragmentation and transaction delays that can hinder high-frequency trading. The Hyperliq Layer 1 network was engineered to solve this problem. It uses an application-specific architecture designed for high-frequency, decentralized derivatives matching. Specialized blockchains successfully eliminate latency and execution drag. However, by isolating themselves from the broader EVM ecosystem, they rely on localized financial infrastructure to maintain capital efficiency. Operating a high-speed order book without a native localized credit facility traps capital within the network. Without an integrated money market, aggregate yield optimization stalls. Quantitative trading firms are often forced to source external capital across bridges to satisfy daily margin requirements. Hyperlend addresses this gap. It operates as the foundational, decentralized lending and borrowing protocol deployed directly onto the hyperliquid network. By bridging sub-second derivatives execution with over-collateralized money markets, Hyperlend allows the ecosystem to function as a decentralized prime brokerage. Hyperlend uses a multi-pool architecture across 3 tiers. Core pools restrict deposits to liquid assets like USDC to maximize depth. Isolated pools use 2-token markets to cordon off volatile asset risk. P2P pools let institutions negotiate custom over-the-counter credit agreements. This multi-tiered structure allows the protocol to aggregate institutional liquidity while preventing the volatility of experimental tokens from affecting the primary reservoirs.
Did you hear how the narrator pronounced the word liquidity just a second ago?
Maintaining solvency in a near-zero gas, high-velocity environment requires mathematically deterministic parameters rather than manual intervention. The protocol uses an algorithmic interest rate formula. The x-axis tracks utilization, the y-axis determines the interest rate. In Regime 1, below 80% utilization, a gradual slope incentivizes borrowing. If demand exceeds this, Regime 2 applies a steep slope to sharply increase capital costs. The steep slope is designed to force existing leveraged borrowers to repay their loans and to incentivize new capital to deposit into the pool to capture the higher yields. By utilizing this curve, the protocol maintains a structural capital buffer, ensuring liquidity remains available for routine depositor withdrawals.
So this is what blew up on Aave, and it looks like Hyperlend uses a similar Regime 1, Regime 2 algorithmic interest rate model. And you see this optimal kink right here at 80%.
I like optimal kink.
It's the optimal kink.
It's not subpar. It's not excessive. It's optimal kink.
Optimal. So what happened on Aave is utilization rose to 100%, which is above that 80% optimal kink, obviously. And so what that means is if utilization is at 100%, interest rates go straight up, but they're capped on Aave. It looks as though even though Hyperlend uses a similar interest rate mechanism, that they may not be capped in the same way.
Even during periods of high demand, custom precompiled contracts allow the EVM layer to send data directly to the native matching engine. This enables HLP vaults to act as automated market makers, capturing trading fees. Hyperlend allows these yield-bearing vault shares to loop back as collateral within its isolated pools.
Right, but Mike, this is what we were taking a look at earlier. The HLP vault itself, it only works if that vault is going to pay you. Like you got to get paid for taking on that counterparty risk.
Oh,
and if
yeah.
if you're not,
what's the point?
Right. So
if you're into losing money, it's like you're into some weird losing money fetish or something.
No, that is a bad kink.
Yeah, bad kink.
Unified trading account architecture.
Bad kink.
Bad kink.
Further reduces complexity, letting users manage cross-margining against their active trading positions with a single cryptographic signature. This enables a capital-efficient yield loop. A user can deposit an HLP vault share, borrow stablecoins against it, and supply those stablecoins back into the protocol to increase their exposure to market-making yields. Converging decentralized money markets with a derivatives matching engine reduces the friction between passive credit and active trading. Supporting these leverage loops requires constant algorithmic monitoring of position solvency to prevent the accumulation of bad debt. The protocol relies on 2 metrics: the loan-to-value ratio, which sets initial borrowing power, and the liquidation threshold, which marks the point of automated cutoff. Smart contracts calculate a health factor for every position. This equation weighs discounted collateral against total debt to monitor solvency risk in real time. If the underlying collateral value drops and the health factor falls below 1.0, the position becomes under-collateralized. This state allows third-party liquidators to repay the user's debt. In exchange, the liquidator receives the collateral plus a predefined liquidation penalty bonus. The zero-gas execution environment.
So that liquidation penalty bonus for liquidator bots, it looked really, really high. Um, so that could actually be, a business model that you might take a look at is becoming a liquidator bot on Hyperlend, because it looks like you could earn like up to a 20% liquidator bonus. That is very high.
Of Hyperlid enables Hyperlend to execute these liquidations with minimal slippage, allowing the protocol to support aggressive borrowing ratios that would be riskier on higher-cost networks. As the protocol matures, Hyperlend is transitioning from its initial core development team. This naturally moves the platform toward a fully decentralized autonomous organization structure. To facilitate this, Hyperlend proposed to align with the Aave DAO as a designated friendly fork. This arrangement involves a 10% perpetual protocol revenue share and a 3.5% fixed token distribution moving directly to the Aave treasury. This specific proposal was designed to secure validation from the industry's largest credit protocol, providing legitimacy for risk-averse institutional participants.
Okay, so that entire last statement, you could almost throw all of that in the garbage in light of what's happened at Aave over the last week and a half. Because if I'm an institution and I see that the largest money market in DeFi can essentially be, ground to a halt and freeze up and basically stop working because of some exploit of something completely unrelated, like a bridge, well,
And
that's
their
not
hands
good.
are tied, because it's again, these institutions, it's their fiduciary responsibility to do what's in the best interest for their clients. And like David's saying, if the protocol, by its very nature, by its very architecture, can happen to where because of an exploit, a single exploit, not even on Aave, but just that contagion can get to a point to where it freezes all the liquidity on the platform. They can't
No,
use it. So
no,
until something fundamentally changes to the architecture, you're not going to see any, if maybe very little, but I doubt it, institutional liquidity being put on Aave.
yeah. And what we've seen, if I just switch on over here to DeFi Llama for just a second, what we've seen. This is Aave's page on DeFi Llama, and this is straight down. You see that
The clip.
TVLs? Yeah,
Last
that is.
last I looked, it was around 50% of the TVL has left Aave.
Yeah, I mean, it was almost at 30. Now it's at 14.
Yeah.
And I mean, dude, like, there's no reason for that to stop. I don't think, because nothing fundamentally has changed. And as these AI models just get better and better, I think there are going to be more exploits, not fewer. And so, if you see,
Well,
there's a difference
to
between.
your point, I think the only reason that there's still 14 is because a lot of the liquidity can't be removed. It's locked.
Well, there's a lot that isn't locked, but it's like, where does it go? Where does it go instead?
Well, I
Um,
think if people could, a lot of that ETH, a lot of those pools that have the different types of ETH that are locked, I would dare say that a lot of that would be taken out and swapped into native ETH or other assets, Bitcoin. We've seen a lot of inflows into Bitcoin ETFs, in the past week or so, since all this happened. We went over that earlier in the show. So I think that it could potentially be there could be still some downside is I guess what I'm getting at.
I agree. I definitely agree. I think that you know the flaw in Aave's model with pooled risk has been exposed, and that means that it's over. It's over for them. They got to go to V4, and I think TVL on V3 continues to dwindle away.
This alignment preemptively addresses competition by linking the economic interests of the Aave and Hyperlend communities. In the competitive decentralized infrastructure space, cross-protocol diplomacy and revenue alignment have become as significant to protocol growth as technical security. Despite its design, the platform inherently carries significant systemic risks. Hyperlens security is strictly downstream of the underlying hyperliquid network. If the layer 1 experiences downtime, automated liquidations may not execute as intended. The protocol also manages derivative collateral risk. A recent incident involving a $4 million loss in an HLP vault illustrates how volatility in perpetual markets can impact underlying vault shares. Extreme pricing volatility could theoretically lead to under-collateralized debt if liquidations cannot keep pace with asset devaluation during market shocks. Looking forward, Hyperlens' roadmap focuses on cross-chain integration. The goal is to allow users to bridge assets from other Layer 2 networks directly into Hyperland to access the ecosystem's liquidity. By resolving the architectural friction between derivatives execution and capital credit, Hyperlend has demonstrated a model for vertically integrated on-chain finance.
Amazing. Great. I still wouldn't use it. Oh, man. Okay. So let's learn about Canton a little bit. And then if we've got time, maybe we can take a look at that subnet on Bitensor DAO.
Right.
But what I really want to learn about here, Mike, is because I was reading on X that there's some type of token incentive thing for Canton tokens. I'm not quite sure exactly what that is. So I just want to see what's that all about. Let's take a look at this. So the Canton paradox, deconstructing the divergence between institutional network utility and structural token depreciation. Okay, here we go. And the ticker here is CC, Canton coin. So here's the institutional reality. And remember, there can be hallucinations in this. This is AI generated, okay? So just bear with me as we go through this. The institutional reality, $9 trillion a month in total transaction volume. Wow, there's no way. Is that really 9 trillion a month, Mike, in volume?
Well, I don't know that exact number, but I mean, just the repo market, because those short-term loans, I mean, that's a lot of, a lot of movement.
I mean, yeah. So that is massive. That is
Yeah,
a lot.
you can see it down there, 280 or 290 to 362 billion in daily U.S. Treasury repo volume.
Well, wow, that is a lot.
Well, I mean, that's why it's generating between $2 and $3 million in fees a day.
So that was the thing that I was so curious about because, people were insinuating that, yeah, the fees are being generated, but that it's not having the effect that it should. I wasn't quite sure. So if there's not.
I've actually really quick. I've actually been having some discussions with people on that topic just this morning, and they had some very valid points. If Canton is being adopted as much as it is, and the way that the tokenomics work with the burn mint mechanism, why isn't the price going up? And it's a valid question. Again, we want people to point out the positives and negatives about all these projects, even if we're bullish on them. So the answer to that is we have yet to reach equilibrium. It is still inflationary. There is still more new tokens being minted than there are being burned. And until we reach that equilibrium, and I'm actually surprised that the price has been stable because being inflationary like that and those tokens potentially being dumped on the market, you would think that the price would be going down, but it's not. It's holding stable. So I'm excited to see as we get, we're at about 0.67 as far as a burn mint ratio, currently. I'm interested to see once we reach equilibrium, if we're holding stable now, if we start to see some price appreciation. And of course, as it becomes deflationary, if we'll see price appreciation. But sorry, I just wanted to inject that kind of, give some context.
Yeah. So, let's see. I do see a liquidity warning, and this is not good. So 2% market depth is only 350K. And so what that means is any whale coming in selling this token at the market in size would move the price and would move the price a lot. So yeah, that's just one thing to know. And it says here, the network has secured a near monopoly on tier one financial integration, yet the underlying asset operates in a state of suppressed valuation. So that's super interesting. And that's really what I want to get into. Why is
Okay.
there why is the valuation being suppressed? So, okay, the BME balance scale. All right, what is this?
It's Ripple and XRP.
No, no. Okay, asymptotic deflationary buffer. Lower price equals exponentially more tokens burned. Okay. Valuation formula, FDV, fully diluted valuation equals market cap.
That makes sense because
Can't,
those that
okay.
don't know, the way that the network works is the fees are denominated in US dollars but paid for in Canton. So like this is showing, the lower the token price, the more Canton tokens are burned. So that's interesting. I didn't. That never clicked for me. I
They,
like that.
they check it, they call it an asymptotic deflationary buffer.
Okay.
Yeah.
I don't like big words. I like
Hey,
the
man. Yeah, I like good things. I do good things.
yeah. Big gun go boom.
Yeah, big gun go boom. So you got this April 2026 flow diagram. Okay, so now we're getting into flows.
So
25,
this is the burn mint that I was talking about. Go ahead.
right. So this is the net daily inflation of 10.75 million Canton.
Mhm.
So the burn mint ratio 0.58 to 0.68x.
That's correct.
Okay. So it looks like inflationary to the tune of 10 million tokens a day.
Yep.
And then you've got this.
That's 100% correct.
So what is the patience tax? So it says until the burn mint ratio crosses 1x, structural oversupply acts as a direct dilution tax on secondary market buyers. 100% of
Yep.
newly emitted tokens are fully liquid upon creation.
Well,
Got it.
and a lot of people might take this as fun. This is just facts. We need to get out of that mindset of those echo chambers. Positive, negative. Just because something sheds a negative light or not an optimal light on your project, it's not doesn't mean it's fun. It's just you need to accept the facts, the data as they are. My second largest holding is Canton. I am, insanely bullish on it. However, you cannot ignore these facts, and these are facts. All these numbers that he's given, I look at daily. This is accurate. So keep going.
100. All right.
100.
Incentive, keeping it 100, just
Keep it
facts.
100. Play it.
Incentive asymmetry matrix and the value drain flow chart. Okay, let's check this value drain flow chart. So you got the protocol, its emissions are 25, 0.75 million tokens daily.
That's the mint.
That's the mint. You've got corporate treasury receipt. So then you've got exchange, spot, book liquidation. So that's crushing the 350K 2% market depth. And then fiat settlement for operational expenses. So it says because rewards subsidize traditional corporate enterprises, Canton operates similarly to proof of work BTC. Miners must systematically dump to fund their fiat runway. Got it. Okay.
Hold
Got
on.
it.
Go through that again. I missed it. Sorry, I was typing something in the chat.
Don't worry about it. I don't really get it either yet.
Because rewards. Well, hold on. Let me read that real quick. Because
Sure.
rewards subsidize traditional corporate enterprises. Okay, that's because they're the validators. They're the ones building, and that's where those minted
Right.
tokens are going.
Right.
Ceasing
And so they've got to
operates
sell them.
similarly to a proof of work like Bitcoin. Miners must systematically dump to fund their. Yeah, okay, I get it. So basically, what it is the minted tokens. They are a lot of them are in turn using those to pay the fees to do the services and move the repo, the repo loans, the markets, so they're it's the same thing as the Bitcoin miners. They systematically have to sell off the Bitcoin to pay the power bill. to upgrade this, the miners and pay people, things like that. There's operational costs. But go ahead.
Yeah. So let's see. This is interesting. So something called Canton Strategic Holdings Inc. pivoted from a biotech firm to a Canton-focused super validator via a $500 million pipe transaction. I wonder, what the hell is a pipe transaction, Mike? I don't know what that is. So it says, digital assets, you got all this Canton, value is $500 million, 8.7% of the total supply. Wow. And the fiat liability trap. Okay, so this is one of the super validators. So we can take a look at that later. In fact, Mike, why don't we, because we've only got a few minutes left, why don't we just play the video content? Let's just see if maybe we can learn about this a bit more quickly by playing this content about the Canton coin paradox.
Okay, let's dive into one of
And Mike, just let me know if you can't hear it.
I can hear it.
the biggest puzzles in the entire crypto space right now, the Canton Network. You see, on one hand, it's this absolutely massive success story with Wall Street. But on the other hand, its own native token, CC, is telling a completely different and kind of troubling story. So just to give you a sense of the scale we're talking about, look at this number. The Canton Network is processing a jaw-dropping $9 trillion in transaction volume every single month. Yeah, that's trillion with a T. This is the kind of real-world usage that most projects can only dream of. And this isn't just a few giant transactions skewing the numbers. That $9 trillion comes from over 1.7 million transactions a day. And the users, they're the biggest names in finance. We're talking Goldman Sachs, JP Morgan, even the DTCC, which is basically the foundational plumbing for the entire global stock market. But, and this is the huge but, here's the paradox. In the face of all that incredible real-world usage, the network's own token, CC, has been, struggling. After hitting a peak of almost 20 cents, it's tumbled over 23%. It's like the token's price is living in a completely different reality from the network's success.
Okay, so there's a couple of different ways that you could interpret that, though, because CC, now, Mike, I don't know what the volatility is for the Canton Network token, CC, but if it's got a relatively high level of volatility, well, then, a plus or minus 30% move should be expected. In fact,
I'm not sure that is correct. Hold on.
I wonder what so it is. It's pulled back by 30% from its all-time high and about 25% from a recent peak.
About 23% from its all-time high of about 19. Yeah, around about 19 cents was about its all-time high. It is currently sitting at just shy of 15 cents.
So Mike, can you see the comment here from Dutch DeFi? He's saying that, can you hold the CC token in a full self-custody wallet? I'm not certain. I don't know.
Yeah, I've been having a little bit of a conversation with him, and I'm just assuming him. But I've been using Braun Wallet, and I know it's not self-custody, but I earn Canton by using it. So it's kind of like the only real kind of DeFi play that I've found to earn free Canton. But it's the only wallet that I've found, and I haven't done like an exhaustive search. But it's the only wallet I've found so far that supports Canton.
Okay, so let's continue playing here.
So what on earth is going on here? That's the core question we are going to unpack today. How can a network that's so loved by institutions have a token that's basically fighting for its life? To figure that out, we've got
So I disagree with that. It is not fighting for its life. I think that it's just normal, expected move volatility based on the level of vol of the underlying token. I think that's all it is.
Pop the hood and look at its really unique economic design. All right, here's our game plan for this explainer. First, we'll cover the network's split personality. Then, we'll get into its economic engine. After that, we'll diagnose its big supply problem, figure out who's doing all the selling, see how the network is fighting back, and then finish with the ultimate bull versus bear showdown. So let's kick things off with Act 1, A Tale of Two Cantons. This is the story of a technology that is, by pretty much every metric, winning the war for Wall Street's adoption, but at the same time, its own currency seems to be losing the battle on the open market. To really understand the token's price action, or lack thereof, we have to look at the network's core mechanic. It's something called the burn-mint equilibrium. And trust me, this is where things get really, really interesting. The burn-mint equilibrium, or BME for short, was built with one user in mind: massive financial institutions. And what do they crave more than anything? Predictable costs. So, unlike pretty much every other blockchain where gas fees go wild, on Canton, you pay for your transactions in good old US dollars. The network then figures out how many CC tokens that's worth at that moment, and poof, it burns them. And this right here shows you exactly why Wall Street loves it. They get stable, predictable costs for their operations. They're totally shielded from the crazy volatility of the crypto markets. But notice the goal here. The whole system is designed for cost stability for the users, not price appreciation for the token holders. And that is an absolutely critical distinction. Okay, so this brings us right to the heart of the issue in Act 3, the great supply problem. You've got a drain. That's the tokens being burned from usage, which is good. But you've also got a faucet. That's the new tokens being minted to pay for security and development. The problem is that faucet is flowing way, way faster than the drain can handle. And here are the cold, hard numbers. Every single day, the network is creating almost 26 million new CC tokens, but only 15 million are getting burned through all that institutional usage. That leaves a net inflation of over 10 million new tokens flooding the market every single day. That burn to mint ratio is just 0.58. It needs to be at 1.0 just to break even. This chart just makes the problem painfully obvious, doesn't it? For every 100 tokens being minted, only about 58 are being destroyed. It's this constant fire hose of new supply, what the source material calls a pronounced structural oversupply, that's creating this massive headwind against the price. So who ends up paying for all this? Well, according to the source, this inflation is basically a patience tax. The network insiders and the app builders get all these newly minted tokens, but it's the passive investors, the retail folks, who have to absorb all that dilution, just hoping that one day the burn will finally catch up to the mint. And that leads us right into Act 4. If there's this much new supply, who in the world is selling it all? The answer isn't who you might think. It's not day traders or speculators. It's the very companies the network was designed to support. After a big network upgrade earlier this year, the way rewards are handed out changed a lot. Just look at this. A massive 62% of all new tokens are now going to application providers. These are the actual companies building the platforms that are processing those trillions of dollars. And here is the absolute key to this whole thing. These application providers are real businesses. They have real-world bills to pay. We're talking servers, developer salaries, legal fees, all of it in US dollars. They aren't holding CC hoping it moons. For them, it's revenue. They are pretty much forced to sell it just to keep their businesses running. And if you want a crystal clear example, just look at Canton Strategic Holdings, or CNTN. It's a publicly traded company. Their own filings showed they're holding over 3.3 billion CC tokens. But look at their cash, only $17 million on hand to cover over $20 million in annual expenses. The math isn't hard here. They have to sell their CC to pay their bills and survive. This is the definition of structural, constant sell pressure. But the network isn't just sitting there and letting this happen. Which brings us to Act 5, fighting back with code. The Canton community, through its governance, has launched a series of pretty sophisticated counterattacks to try and wrestle back control of the token's economics. And they have been busy. Back in January, they cut the rate of new token creation in half. Then they completely restructured the rewards to give more to the apps that have the most usage. And most recently, in April, they passed something called CIP 105, which is a powerful new tool designed to lock up supply. Now, CIP 105 is the really big gun. It forces the network's...
So, Mike, CIP, what was it? CIP 125?
I believe that's what it was.
Yeah.
I don't know about that, if that's 100% accurate, but the end result is accurate.
Got it.
Heaviest hitters, the super validators, to lock up a huge chunk, 70%, of all the CC they have ever earned. And if they decide they want to unlock it, it takes a full 365 days. This is a deliberate move to synthetically pull billions of tokens off the open market, creating a kind of forced scarcity to fight back against that daily inflation. And that all brings us to our final act, the bull versus bear showdown. We've seen the powerful forces that are pushing the price down, and we've seen the networks.
Hey, why is the bull all jacked and the bear's fat as fuck?
All right. Well,
Defenses.
the bear,
So now
the bear is
let's lay
eating
out
better.
Yeah, I guess so.
the final arguments for where Canton Coin goes from here. The bear case is pretty straightforward. You've got that structural inflation from the constant minting, you've got relentless sell pressure from companies that need cash, and the market just isn't deep enough to absorb it all. But the bull case, it's just as compelling. You have massive, real, and growing institutional adoption, complete dominance in the real-world asset space, and a huge wave of game-changing new projects about to go live. And believe me, this wave is the real deal. The DTCC is about to start tokenizing US Treasuries on Canton. Goldman and JP Morgan are already running their platforms on it. And Visa just jumped in as a top-tier super validator, which signals a huge push into global payments. Every single one of these things is going to require burning more and more and more CC.
Hmm.
So we end right back where we started.
Really quick, pause that, because I'm having a conversation in the chat with somebody new. I haven't seen the name before, Spider Greg, but has been sharing some really good information. I'm kind of trying to fact check some of it, while we're live. But made the comment, again, need to fact check it, that there is a bot that basically works to maintain the price of Canton within a channel to ensure that basically optimize the network, so that if it gets too expensive, then it doesn't burn as much. That graph that you showed at the beginning, it doesn't burn. It will burn less Canton, so it will throw the ecosystem out of whack. If it's generating or minting so many tokens, if the price goes up, then the amount of Canton being burned is going to go down. So I think that he's probably right to a point if there is a bot like that. But even if there is, I think that as the halvings that are happening, and the amount of tokens, new tokens being minted is going down, then potentially the price can go up and it will still burn enough tokens to not throw everything out of whack. I hope that makes sense.
Yeah, it does. So, we've got just a couple seconds left here, and then we're going to run out of time. But, Mike, as we were going through this, I put together some research on the VE33 tokenomics. And so maybe at some point this week, we can take a look at some of that research. I'm sure it'll be interesting.
The bears, well, they have the current data on their side. You can't argue with the inflation and the sell pressure. But the bulls have this unprecedented tidal wave of real-world finance heading straight for the network. The ultimate question is this: will trillions of dollars in institutional volume finally be enough to flip the switch, to soak up all those sales and turn the Canton coin paradox into a story of profit? Only time will tell.
I think yes. I think the answer is yes. So, with all that, Mike, you want to just wrap things up here by taking a look maybe at our website and our programming, or what do you think?
Yeah. Go ahead and I talked about it at the beginning of the show. I mean, maybe you can touch on a couple of things on the website, and then we'll just kind of wrap things up.
Yeah, so all the programming that we run here every day, this really is a network. And with 14 original shows and 26 live broadcasts a week, this is really, really cool. Now, I need to go in here and fix the subscribe button, because I've got this pointing right now to some random channel called the Node channel on YouTube. The wrong one, though. So I need to fix that. But every show in here, every day, all times are Eastern. So you're watching the Node Daily Show right now. Immediately after this, we've got the Blockchain Report with Jeff. And then at 4 o'clock Eastern, we've got my daily market wrap. And then, I've got in the school community, these are the paid calls in school, the Investor Mindset Lecture and the Market Review and Week Ahead. Tomorrow, Tuesday, same time, we've got at noon, the Node Daily Show. And then, of course, the daily market wrap every day at 4. But on Tuesdays and Thursdays, I run that with Ellie. Ellie joins for the second half of the call, and we run through a private coaching session. And then we've got Crypto and Chill. That's Mike and Jeff on Tuesday evening, 8 p.m. Eastern. On Wednesday, of course, the Node Daily Show, and immediately after that, the Blockchain Report. Then we've got the Daily Market Wrap, and then in the school community, we've got Liquidity Provision, that lecture, and the Portfolio Clinic. And then in the evening, we've got Gaming and Chill with Ellie and Jay. On Thursday, Node Daily Show, and then immediately following that, the Blockchain Report. From there, we've got the Daily Market Wrap and TA Call, and since it's on Thursday, that's a private coaching session with Ellie also. And then in the evening, we've got the Red Pill, and this one's a lot of fun. This is, not just myself, Mike, Jeff, everyone else. It's also friends of the network, so we invite on special guests. A lot of fun there. On Fridays, you got the Node Daily Show, of course, at 12 noon. You've got the Daily Market Wrap at 4. And then in the school community, Perpetual Futures Lecture, and then AMA and Open Office Hours. And then with Mike and Jeff at 8 p.m. Eastern on Fridays, you got Crypto and Chill. And then on Saturdays and Sundays, on Saturday, you've got Sovereign Soil with Mike and whichever guest he decides to have on. And then you've got Saturday Night Fever with Jeff. And this one's a lot of fun. Jeff is a really talented DJ. And then on Sunday, you've got Gaming and Chill with Ellie and Jay, and Mike. Mike likes to join that too. So this is all of our programming. This is pretty cool, I gotta say. We've done a lot to get to this point in just a couple of weeks.
And also your daily live calls, in DeFi University,
Right. Yeah, those are in there, and they're right here in blue. So I changed it to Monday, Wednesday, Friday in DeFi. So, yeah. And thanks everyone for joining live. Mike, I'll throw it back to you.
All right. Yeah. I just wanted to throw this up, because it's something that we talked about. So I went and sought out confirmation. So yeah, DLR Broadridge transacts 1 trillion a month. And this is the Broadridge that's doing the repo market that's on Kent. So yeah, I mean just that one company as of so far, they're doing $1 trillion a month in repo transactions. So that kind of lends some credibility to the figures that David was throwing up earlier. So appreciate y'all again, and join us after this. Well, hold on. Let me check real quick. So the rest of the day, what do we got going on today? We got blockchain report is right after this, and the market wrap later today. And I think that's all we got for today. So until next time, we'll see you. See you then, or see you tomorrow morning. Veteran Crypto out.
Peace.